Hello all, I'm going to be talking to you today about client money obligations of insurance distribution firms under the FCA's CASS 5 rules. So what I'm going to try and do is to be pretty comprehensive in terms of topics covered, and then guide you to the relevant provisions so that you can understand what those mean when you look at them. So the aim here is to cover the key points of principle. Okay. The nature of the client money problem. What is the client money problem in overview? This applies to insurance distribution firms, what I'm going to call brokers, insurance brokers, investment management firms, payments firms, e-money issuers, and others. These are all firms that have client money issues. Just to be clear, banks in their normal banking activity don't have client money issues, and insurance businesses don't have client money issues. So it's a proportion of financial services businesses that have to deal with client money. The failure to manage client money properly has massive implications for customers of these firms. I reckon it's one of the top 4 regulatory risks that brokers face. I think the other risks that they face are in terms of their remuneration, because brokers are often are paid by insurers, and that creates conflicts of interest. Consumer duty issues around their pricing, issues around their governance, control of appointed representatives, and so on and so forth. But client money is right up there as one of the things that they have to do properly. The client money problem has been the subject of numerous FCA enforcement cases, skilled persons appointments, internal investigations, and so on and so forth. So failure to manage these things properly, it's very expensive for insurance brokers, even when they don't cause actual client losses. Okay? Why is there a client money problem? As one of my colleagues once said to me, why is it that firms that have obligations and who hold client money often seem to get into trouble? Well, I think these are the reasons. The rules are fiddly and difficult, as we will see. No one really understands the true legal consequences of failure. I'm going to have a go at that today, but it isn't easy to work out what's going on in terms of legal process. There is a business gain in not fully complying if your breach isn't detected. The controls put in place are often manual. It's human beings looking at things, looking at spreadsheets, trying to reconcile them. And when they're not manual, they're automated and systems can go wrong. It can be difficult for senior management to really engage because, as I say, the rules are very, very detailed. Responsibility is often split between compliance and finance functions within firms. So there's all the recipes for things going wrong, split responsibilities. And the commercial benefits to brokers and insurers are not aligned, is the other reason why I think these rules cause problems.